Welcome to this video on investment in fixed income securities, chapter 9. The video is about investment advisor certification level 1. In this video, I will take you through some questions which will help you understand key concepts related to fixed income securities. So this is more like a concept check. This is not essentially the kind of questions that may come. But if you go through this video, you should be able to gauge your level of understanding of fixed income securities. So let us start and discuss 20 conceptual questions in multiple choice format in this video. So the first question is, what is the primary purpose of debt market? So since the question is on fixed income securities, we are talking about debt market. So debt market has multiple purposes, right? But from the options that you see here, it is very obvious that debt market, like the financial market, helps in moving funds from savers to the investors. It is a source of channelizing the money from those who have excess of it to those who need this, right? So when a corporate bond or when a bond is issued, okay, the bond issuance is done by either government or by companies or by banks or by insurance companies, and that the money from those who have excess moves on to these, all these players whose name I just mentioned. So the primary purpose of debt market is to reallocate funds from savers to investors. Question 2. What is a key characteristics of perpetual bond? What is the meaning of perpetual bond? The simple meaning of perpetual bond is that perpetual bonds, as the name suggests, they are forever. So high liquidity, convertibility to equity, fixed interest rates, all these are not correct answer. No maturity date is the right answer because it is a perpetual bond. Question number 3. Who are the primary issuers of bonds in debt market? So who issues these bonds? And typically in large numbers: insurance companies, banks, mutual funds, corporation and governments. In fact, in a country like India, the largest issuer of the bond is government, followed by companies. Okay, so we will put the answer as B. So that's your answer for this question number 3. Let us move to question number 4. The risk of bond price changing due to interest rate movement. Because interest rates are going up and down, bond prices may also move up and down because bond price and interest rates have opposite relationship, right? So we call this as the which risk? Market risk. Just to let you know, in market risk, 4 types of risks are included. Market risk is made of equity, interest rate, commodity and foreign exchange risk. So this is the market risk, right? Let us move to the next question, which is question 6. If a bond's coupon rate is higher than the prevailing market interest rate. Now coupon rate is more, prevailing market interest rate is less, right? So in this situation, what will happen? In this situation, the bond will trade at a premium. Remember, there are only 3 situations. When coupon rate is equal to prevailing interest rate, the bond will trade at par. When coupon rate is less, the bond will be trading at a discount, but when the coupon rate is more, it will be trading at a premium. Next question is, the par value of a bond refers to what? This is a term which is often used. So par value of a bond is nothing but its face value, right? And face value is what you get back on redemption. No matter at what price you buy a bond, what will you receive on maturity is the redemption value. Redemption value is paid by the issuer to the subscriber. So that's the par value. Let me again repeat that we are trying to help you understand the concepts related to bond in a better way. These questions have been designed with that objective. They are not essentially those questions that you can expect in exam. If you get some of these questions, it is maybe just a coincidence, right? But you will definitely be able to refresh your understanding of debt market. The next question, yield to maturity. What does it mean? It, as the name suggests, this is the yield that you get till the time you hold a bond till maturity from the date on which the bond has been purchased by you, which should typically be the issue date. So bonds are sold before maturity. Well, that's not the right. Market interest rate remains constant and coupon are reinvested at YTM. Well, these are the two assumptions which are there as part of YTM. Both the things must hold good. So the answer will be both B and C. So market interest rates must remain constant first. They should not change, because when the market interest rates change, the reinvestment value will change, right? And coupon is reinvested at YTM, right? So whatever is the YTM, you continue to reinvest it at that rate. That's the idea. Question number 9. This is a very important concept called as yield curve. So what is an yield curve? Yield curve is a it's a curve, or it's a line which is watched in bond market very carefully, because this indicates what kind of interest yield is prevailing over different periods of time. They are upward sloping, right? So a yield curve does not show the relationship between bond price and coupon, stock market and bond returns, bonds duration and risk. It shows the relationship between bonds yields and maturity. So we have done 9 questions so far. Question 10. Duration is what? Duration is exactly measuring what? So the question is, duration is used to measure what? So duration is different from maturity. So duration, maturity means in how many years the issuer will pay back money to you. But duration is neither measuring liquidity nor measuring credit worthiness, and it is definitely not maturity. So it is nothing but sensitivity of bond price to change in the interest rate. Now this is what we call as modified duration. We have two types of duration, modified and maculate. Maculate duration will only tell you how much time will it take for you to get your investment back from the bond. But modified duration will tell you duration, sensitivity of bond price to interest rate change. This question obviously is about modified duration. If a bond has high duration, what does it mean? If a bond has a high duration, it simply means one thing, that bond is more risky. Because when the duration is high, the effect of interest rate change on the bond price is much more. So if the duration of a bond is 10 year and duration of another bond is 5 year, it is very clear that the 10-year bonds price will change more compared to 5-year. So we will say that the answer is A, which is greater sensitivity to interest rate changes. Right? Move to question number 12. Which of the following is not a money market instrument? Now that's very interesting. Treasury bill is money market. Certificate of deposit is money market. Commercial paper is also money market. In case of certificate of deposit, one thing that we should note is when financial institutions issue certificate of deposit, it may range from 1 year to 3 years. Still, we call certificate of deposits as money market instruments. Banks issue it for less than 1 year, but financial institutions can issue it for more than 1 year. So the answer will be convertible bond. Convertible bonds are the bonds which are not money market instruments. Question number 13. Government securities are considered risk-free for what reason? Do they have fixed interest rate? Do they have high quality? Are they backed by physical assets? No, nothing like that. Government securities do not have default risk. Government in the worst case scenario may just print currency and give it to you, but it will honor its own commitment. That's not the situation that we want to be in, but that's a fact. So they carry no default risk, and because they do not have default risk, are considered to be risk-free. Just a reminder, you are just understanding your concept of fixed income securities by attempting these questions. A key feature of treasury bills is that they are issued at premium. They pay coupon periodically. They are zero coupon securities restricted to institutional investors. Well, the answer is C, zero coupon securities. You may argue that treasury bills may be issued at premium in situations when the interest rates are negative. Well, that's not something that we have in India. So we will go with the answer. They are zero coupon securities. They don't pay coupon. You buy a T-bill at X price and you receive 100 rupees per T-bill on maturity. The next question is quiz 15. What is the major change in Indian corporate debt market? Sorry, what is the major challenge in Indian corporate debt market? Apologies. Lack of regulatory oversight. Well, no, SEBI is a very good regulator and takes care of the market. High outstanding stock of individual debt issues. Obviously, no. Limited trading volume. Yes, this is a big issue. The debt market in India, especially the corporate debt market, does not have enough liquidity. The tradings are very few. What does call risk refer to in case of bonds? Bonds have call risk. Call option is added by the issuer to a bond when they have right to call back the bond. So is call risk about risk of default on coupon? No. Risk of early redemption by the issuer? Yes. This is definitely the call risk. The risk of price volatility due to change in interest rate is interest rate risk. And risk of low trading volumes is liquidity risk. So the answer will be B here. So we are done with 16 questions. 17 question, which is the last before we start with a small case. Floating rate bonds differ from fixed rate bonds because their interest payment depends upon credit rating. No. Tax free? No. Based on market demand? No. So what is the answer? They are linked to a reference rate. Reference rate means when you buy a floating rate bond, it may be linked to MIBOR, okay, or any other reference rate which is available. Correct? So let us move to question number 18, which is a small case, and then we have 3 questions that will come. So Rahul, a 35-year-old investor, wants to allocate a portion of his portfolio to fixed income securities. He considers purchasing bonds with varying maturity and coupon rates. Rahul has a monthly saving of 20,000 and he aims to build a corpus of 30 lakhs for his children in 15 years. Currently, he is evaluating options such as government securities, corporate bonds, and mutual funds focused on fixed income investments. What is Rahul's primary objective for investing in fixed income? Will he achieve higher returns? Minimal portfolio volatility? Speculate in bond market and take advantage of tax savings? Well, he is going to achieve minimum portfolio volatility because these bonds that he is planning to invest in will have less fluctuation in terms of price. Correct? Next question. Same question. If Rahul invests for 15 years, or rather in a 15-year bond with 6% coupon rate, how much annual interest will he earn on 10 lakh rupees invested? It's very clear. If you are investing 10 lakh rupees and you are getting 6% coupon, 6% of 10 lakh is simple. It is 60,000. Right? The next question, which is the last one in this video. So the same problem remains. So what is the role of duration in bond investment for Rahul? So we have already learned a part of duration. Measures the sensitivity of price rate due to change in fluctuation, indicates maturity of the bond, determines the amount of coupon, reflects the credit risk. Well, no, this is the first one which will be the right answer. So in this video, which is little lengthier, I have taken you through how many questions? 20 in all. I hope you found them to be useful. If so, please like this video, subscribe to the channel and refer it to your friends. Thank you so much for your valuable time.